prices just went above $100 a barrel again. Big move, very big, tremendous move. And let me tell you, whenever oil prices does this, the whole world starts to get very nervous, including investors, markets, and government, everybody. And the reason is simple, because right now there's serious tension in the Middle East, especially around Iran. There are heavy airstrikes happening in Tehran, the capital city of Iran. Very big in airstrikes. And a big issue people are watching is a place that is called the Strait of Hormuz. Now that name sounds very fancy, but the Strait of Hormuz is actually very narrow water route where a huge amount of world oil passes every day. Think of it like a highway for oil ships or oil tankers. But right now, that highway is basically blocked. And when oil cannot move through this highway, guess what's gonna happen? Oil prices are gonna go up very quickly. That's why oil price shot up above $100 a barrel, and at one point even touched around $119 per barrel. That's a very big jump. Now, when something like this happens, the funny part is what investors start to do. Okay, right now investors have started to do what we call run to safety. This means that they start to sell their government bonds and pack their money in safe haven assets. Now, let me explain bonds, government bonds, because people hear the word and think that it's something very complicated. Actually, it's something very simple. A government bond is basically when you lend money to a government and the government says, thank you very much for lending this money. I'm going to pay you interest on this money that you lent me. That's it. Very simple. So when investors think that there's going to be a rise in inflation, they usually don't like to hold on to their bonds. So they usually want to sell off their bonds and pack their bonds in safe haven asset. And that's exactly what's happening right now. Once oil price jumped, investors around the world started to sell their government bonds, because whenever oil becomes expensive, then inflation is very, very likely to rise. Okay, inflation simply means the prices of goods and services, food, transport, electricity, everything rising up. A quick example of how this works is, take for instance, if crude oil becomes expensive, then petrol or gasoline is going to become expensive as well. And if petrol or gasoline become more expensive as well, then transportation cost is going to go up. And if transportation cost goes up, then moving food and goods from one places to another is gonna be much more expensive, and then suddenly your tomato and rice and bread and everything in the market are also gonna get more expensive. So you see how they spread. So you see how inflation does spread across the economy. Crude oil touches everything. So now, because investors are scared, they're starting to move their money into what we call safe haven currencies. A safe haven is basically a place where money runs to whenever the world looks messy, whenever there's war, uncertainty and chaos. And two of the big places money runs to is the US dollar and the Swiss franc. As a result of crude oil prices rising and the possibility of inflation to become higher, the US dollar and the Swiss franc have become stronger. Now, if the US dollar becomes stronger globally, you already know what that means for foreign currencies. Foreign currencies, of course, are going to get weakened. But Switzerland currency, which is known as Swiss franc, is also a safe haven asset. Swiss franc is quite interesting because Switzerland is known for being very stable, very calm. They have very nice chocolate, and they're a very neutral country. So investors prefer to park their money in the US dollar and the Swiss franc for now. And then there's an exception to foreign currencies that are getting weakened, and these currencies are of countries that do export oil. Take for instance countries like Norway. Norway currency has been rising, and this is because Norway is an oil producing country. So whenever crude oil prices increases, oil producing countries are going to be smiling. Countries that rely heavily on the import of crude oil and energy, many of them like the European countries, they are starting to feel the pressure because their currency weakens and the cost of energy rises. So that's why investors are watching this situation very closely. Another thing that has changed is the expectation of interest rates. Interest rates are basically the cost of borrowing money. Before the conflict in Iran escalated, investors believed that central banks like the US Federal Reserve would start putting interest rates more in 2026. But when oil price jumped higher, inflation fears came back, and investors and the market have now begun to cut back on their rate cut expectations. So you see how one geopolitical event or one conflict can suddenly affect the financial market across the world. Now, the big worry right now is that this conflict might last longer than people actually expected. At the beginning, many analysts thought that the conflict would be very quick because the president of the United States of America said that the strikes in Iran is going to be a very short military operation. But now some experts are saying that it's going to become a long regional conflict, and the market hate this kind of uncertainty whether the conflict is going to end now, it's going to end then. And because investors don't know what to do right now, so they're very cautious. That's why they're moving their money to safe haven currencies. And so as we can see right now, oil prices rising, dollar is rising, Swiss franc is getting stronger, the bond market is reacting, all because of tensions around the narrow shipping routes that most people have never heard of before this week. Amazing how that works. So the lesson here is simple. You might not trade oil, you might not follow the global financial market, but whenever crude oil prices moves, it affects the entire financial market. It affects your fuel price, it affects your gasoline price, your transportation costs, and the price of goods in the market.